Welcome to the Byte-Size Brief. Today we are putting SPY, that's SPY, completely under the microscope.
We really are. And honestly, there's a lot to unpack here.
There is. Let's get right into it because we are looking at a deep dive into the absolute biggest bellwether of the entire U.S. stock market.
Right. If you are an investor, you definitely know SPY. It's the Titan.
Exactly. Imagine being the undisputed king of the stock market for like 32 straight years. You hold hundreds of billions of dollars and you are universally recognized.
Yep, the ultimate barometer.
But then, suddenly, you find out about this hidden legal limitation written into the internal architecture way back in 1993. And it literally forces you to lose your crown.
Wild to think about.
It is. So today, we are looking under the hood. And what we found in the research completely shifts how we have to think about this asset.
It really does shift everything. And just to set the data-driven context for you, as we record this on April 22, 2026, SPY is trading right near $710 a share.
Which is huge.
Yeah, it recently tested its 52-week highs. So on the surface, looking at a simple price chart, it looks like a picture of, absolute unshakable strength.
Right.
But when you actually dig into the underlying data, SPY is quietly undergoing a really profound structural identity crisis.
See, I've been looking at SPY basically like a classic 1960s muscle car.
Oh, I like that analogy.
Right, like it is iconic, it's undeniably powerful, everyone recognizes it when it rolls down the street.
Sure.
But you have to ask yourself, is the actual engine under the hood starting to show its age compared to, newer, more efficient models?
That is exactly the core tension here. Because to really understand the current state of SPY's engine, we first have to look at the incredibly volatile road it's driving on right now.
Yeah, the second quarter of 2026 has been a ride.
It has. The macroeconomic data tells a story of intense global friction, which makes its current price point pretty fascinating, honestly.
Let's talk about that friction because the first quarter was anything but smooth sailing.
No, it was a very rocky start. In Q1, SPY saw a year-to-date dip of around 4.33%.
Ouch.
Yeah, and this was primarily driven by the escalating macro backdrop, specifically the U.S.-Iran conflict.
Right, and the massive oil supply shocks that came with it.
Exactly. And we also saw renewed concerns over global trade tariffs. But despite that very real early stumble, SPY just recently surged back up by 5.87%.
Landing us near that $710 mark.
Yep. And Wall Street analysts currently have targets for the underlying index sitting anywhere between 7,500 and 8,000.
And that optimism is largely driven by this massive artificial intelligence capital spending boom, right?
It is. But there is a massive divergence happening between different financial markets right now.
What do you mean?
Well, because of that geopolitical backdrop and the looming potential of a sustained oil shock, the bond market is flashing intense inflation warnings.
So bond traders are panicking a bit.
Yeah, yields are staying elevated because they expect inflation to remain sticky. And yet, the equity side of the equation represented by SPY is pushing upward to new all-time highs anyway.
Okay, hold on. How does that actually affect SPY's stock price for regular investors like me?
Well,
Because from a retail perspective, it feels like the bond market is this flashing check engine light coughing its lungs out about inflation, while stock investors are just like turning up the radio to ignore the sound. Are equity investors just completely delusional right now?
well, no, it's not a delusion. It's more of a hyper-specific calculation about what the equity market is choosing to price in.
Pricing imperfection.
Basically, SPY's current resilience is heavily reliant on the market pricing in a best-case scenario. Equity investors are just looking past the current supply chain and oil constraints,
Hoping for the best.
betting heavily on a potential geopolitical ceasefire, really. But more importantly, they are pricing in absolute perfection for tech earnings.
Because of AI.
Exactly. The assumption baked into SPY right now is that the corporate productivity gains from AI will significantly outpace any localized inflation or energy cost spikes.
So SPY is basically a concentrated bet that the AI revolution will just bulldoze right over those macro speed bumps.
Precisely. That's the bet.
Okay, so compared to last quarter, what actually moved the needle here?
The internal makeup.
Right, because if SPY is bulldozing over these inflation fears, its internal mechanics must be shifting drastically.
Oh, they are.
Are investors just not relying on this as a safe income play anymore?
They absolutely cannot rely on it for income anymore. The internal mechanics have drastically shifted quarter over quarter and year over year.
So the engine is different.
Completely. And the most stunning data point in our research center is directly on that income.
The dividends.
Yeah, the dividend yield for SPY has completely collapsed. It's currently sitting at just 1.24%.
Wait, 1.24%? That's historically low, isn't it?
It's incredibly low. It is the lowest dividend yield level for the index since the absolute peak of the dot-com bubble over 2 decades ago.
Wow.
Historically, dividends have accounted for roughly 30% of the index's long-term total returns. But right now, that income engine is essentially running on fumes.
But why the sudden drop? It's not like the companies making up the index are failing to generate cash. I mean, they are making billions upon billions of dollars.
They are generating massive cash flows.
Yeah.
But it all comes down to who actually rules the index today.
The tech giants.
Exactly. The top 10 companies in SPY now account for roughly 38% of the total index weight.
Almost 40%. That's huge.
It is. And those companies are almost exclusively big tech. And what are they doing with their cash?
Plowing it into AI.
Yep. They are funneling billions into AI infrastructure buildouts, data centers, computing chips, and share buybacks. They are aggressively choosing not to write dividend checks to their shareholders.
So basically, it's kind of like squeezing a dry sponge.
That's one way to put it.
Like, if I want to generate $10,000 in income, how much do I actually need to put into SPY today?
The math is incredibly harsh right now. At a 1.24% yield, you would need over $800,000 invested in SPY just to yield $10,000 in annual income.
800 grand just to make $10,000.
I know, it's brutal.
That is wild. Think about someone who spent 30 years saving up, say, $500,000 for retirement. They look at SPY and think, this is the safest bet in the market.
But they'd barely clear $6,000 a year in dividends.
That doesn't even cover property taxes in most states.
Right. It highlights a fundamental identity shift that investors really need to be aware of. SPY is no longer an income engine.
So what is it?
It is transformed into an almost pure AI-driven growth vehicle. And we see that reflected in its current valuation. It is trading at an elevated price-to-earnings ratio of 26.17.
Just to clarify that for a second, a PE ratio of 26.17 means that investors are willing to pay over $26 today for every single dollar of profit these underlying companies generate over a year.
Exactly. They are paying a massive premium because they are betting on future AI-driven growth, not current income.
Okay, here is where it gets really fascinating to me.
Yeah.
If SPY is now almost purely a growth and capital appreciation play rather than an income play, then every single fraction of a percent in performance matters, right?
Absolutely, because you aren't getting paid a massive dividend to just wait around.
Exactly. You need the share price to compound. And that leads us directly to this massive hidden structural flaw in SPY's architecture that our sources highlighted.
Yes. This is the bombshell that really reshapes how we have to view this asset.
The 1993 thing.
Right. In early 2025, SPY was officially dethroned. It lost its title as the world's largest ETF.
Which ended a 32-year reign at the top. Unbelievable.
Yeah.
Where'd all that money go?
Well, SPY hemorrhaged $29 billion in outflows. Meanwhile, its direct competitors, the newer funds, tracking the exact same index, gained over $100 billion.
So investors are literally abandoning the classic muscle car for newer models. But why? Are the newer funds just drastically cheaper?
The first layer is the fee, yes. SPY has an expense ratio of 0.0945%. Its primary competitors charge just 0.03%.
Okay, but let's put that in perspective. On a $100,000 investment, that is a difference of what, about $60 a year?
Basically, yeah. It is practically microscopic.
Right, $60 a year isn't exactly a reason for Wall Street institutions to move $100 billion around. There has to be something deeper going on.
There is. The real issue is the vintage 1993 architecture of the fund itself.
The structural limits.
Right. SPY is legally structured as a unit investment trust, or a UIT.
Which is different from modern ETFs.
Very different. Modern ETFs are structured as open-end funds. That 1993 UIT structure places 3 severe operational handcuffs on SPY.
Okay, let's unpack these handcuffs. What is the first one?
The first is what we call cash drag. Because of its UIT structure, SPY legally cannot internally reinvest the dividends it receives from its underlying companies.
Wait, explain that. So if Apple pays $1 billion in dividends to the SPY trust on May 1st, but SPY isn't scheduled to distribute that cash to me until May 31st, what happens to that money for those 30 days?
It literally just sits there in a non-interest-bearing cash account, doing absolutely nothing until the designated distribution day.
You're kidding?
No. In a roaring bull market, where the broader market might jump 3 or 4% in a single month, having millions of dollars sitting in cash instead of being immediately reinvested, it creates a measurable drag on performance.
So basically, it's kind of like keeping your paycheck under a mattress for weeks instead of putting it in a high-yield savings account the second you get it. The money is just sitting there doing absolutely nothing.
It's actually worse than a mattress, if you think about it. With a mattress, your physical money is just dormant. But here, the overall market is actively rising around you while your cash sits in a zero-interest account.
Ah, so you're losing out on the gains.
Right, you're actively losing purchasing power within the fund itself because you are missing out on the compounding growth of those specific days. The modern competitor funds take those dividends and immediately buy more shares of the index.
Compounding the growth instantly.
Exactly.
What?
SPY legally cannot do that.
Okay, so cash drag is the first massive issue. What's the second handcuff? I saw something in the research about short selling.
Yeah, securities lending. Usually modern mutual funds and ETFs make a little bit of side income by lending out the shares they hold to short sellers who want to bet against the market.
I'm guessing this 1993 legal structure completely blocks SPY from doing that.
You hit the nail on the head. That is the second handcuff. Modern open-end ETFs can lend the stocks they hold to institutional short sellers. The short sellers pay a fee to borrow those shares, and the ETF passes that extra revenue right back to the shareholders.
Effectively boosting the fund's overall returns.
Yes, but because of its strict 1993 UIT constraints, SPY is strictly prohibited from lending out its portfolio. It leaves that extra yield entirely on the table.
Wow. It's like owning a rental property but legally not being allowed to lease out the guest house. You're just leaving money on the table that your neighbors are collecting.
Exactly. And then there's the third handcuff, which is tax efficiency.
Now, I know taxes eat into returns, but how does an ETF structure prevent that better than a 1993 UIT?
It comes down to a mechanism called an in-kind redemption.
An in-kind redemption.
Yeah, imagine you and a bunch of friends pool your money to buy a massive multi-million-dollar art collection.
Okay, tracking with you.
If one friend suddenly wants out and wants their money back, you could sell one of the paintings, pay capital gains tax on the sale, and hand them the cash.
But that hurts everyone else left in the pool.
Right, because now the pool has less money and a shared tax bill. So instead of doing that, modern ETFs use an in-kind redemption.
How does that work?
It's like just handing that exiting friend one of the physical paintings and saying, here, you go sell it yourself. The fund itself doesn't trigger a taxable event.
Oh, that makes sense.
When a huge institution wants to pull $1 billion out of a modern ETF, the fund just hands the institution the underlying shares directly.
Yeah.
This avoids triggering capital gains taxes inside the fund, which protects the everyday retail shareholders.
But SPY can't do that.
SPY's older UIT structure is far less flexible with these tax-efficient maneuvers.
Man. So you have a microscopic cash drag, missed revenue from securities lending, and less tax efficiency.
Yep, all adding up.
What does that actually look like in terms of real numbers for a long-term investor? Because individually, they sound pretty small.
Well, over a 10-year span, the data shows that these structural limitations caused SPY to yield a 12.18% annualized return.
Okay.
While it's direct, modern competitors tracking the exact same companies yielded 12.28%.
0.1%. I mean, it doesn't sound like a lot when you say it out loud.
It really doesn't.
But if you are an everyday investor buying and holding for a 30-year retirement, that 0.1% compounded over decades isn't just a rounding error. That is tens of thousands of dollars completely missing from your nest egg.
Precisely. For a long-term buy-and-hold retail investor, those structural limitations create a very real, measurable drag on compound interest.
Right, but what does all that actually mean for SPY investors today?
Good question.
If it has an outdated 1993 architecture, higher fees, cash drag, missed lending revenue, and less tax efficiency, why hasn't it just completely crashed? Why are people still pouring money into it?
Because for a specific type of investor, SPY is still the ultimate trading tool on the planet.
Okay, who is that specific investor?
The institutions. It all comes down to one critical word: liquidity. SPY has a liquidity moat that is virtually impenetrable by any newer fund.
Define that moat for us. How big is the gap between SPY and the competitors that dethroned it in total assets?
The volume difference is staggering. While the newer, cheaper competitors might trade $4 to $5 billion worth of shares in a single day.
Which is still a lot of money.
True. But SPY trades an average of $51 billion a day.
$51 billion per day.
Yeah. It boasts a 30-day average volume of up to 86.8 million shares changing hands daily.
Okay, so it is trading 10 times the daily volume of the funds that actually hold more assets. Why does that daily volume matter so much to the big players?
Think about what happens if you are a massive hedge fund and you need to move $500 million into the market in a matter of seconds.
I'm sweating just thinking about it.
Right. If you try to buy $500 million of a smaller, less liquid ETF, you will literally drive the price of the ETF up while you are buying it.
Oh, because you're eating up all the available sellers at that price.
Exactly. Your first share might cost you $400, but by the time you fill the whole order, your last share might cost you $405.
And that difference is called slippage.
Exactly. Because SPY is an absolute ocean of liquidity, you can execute a massive $500 million trade instantly without moving the needle at all.
Wow.
The trading spread, which is simply the gap between what a buyer is willing to pay and what a seller is willing to accept, effectively rounds down to zero. There are so many participants that the gap just vanishes.
And options play a massive role in this liquidity moat, too.
A monumental role. SPY features the deepest, most active options market on planet Earth.
The deepest.
Yeah. If you manage a state pension fund and you need to protect a multi-billion-dollar equity portfolio from a sudden 10% market drop using complex derivative strategies, SPY is literally the only vehicle capable of handling that kind of volume without the market breaking a sweat.
So SPY is like a massive wholesale market.
That's a great way to put it.
If you are a massive institution moving millions of dollars in a split second or executing complex daily options trades to hedge a pension, that zero spread execution and deep liquidity completely offset that slightly higher fee and the cash drag.
100%. You make your money back in execution quality.
But for everyday investors like me who are just buying a few shares a month in a Roth IRA and holding for 20 years, we are paying a premium for a high-speed lane we don't even use.
That is exactly the dynamic at play here. You are paying for institutional-grade plumbing that a retail buy-and-hold investor simply doesn't require.
Well, this has been an incredibly eye-opening deep dive. To summarize everything we've talked about today, SPY remains the undisputed king of liquidity.
Undoubtedly.
It is the ultimate market barometer, currently brushing off macro inflation fears and geopolitical noise to ride the AI tech wave near $710.
Right.
Yet its 1993 unit investment trust architecture makes it a complex choice for the everyday retail investor.
It really does. And I want to leave you with a final provocative thought for you to mull over, building on everything we discussed.
Let's hear it.
We know that the top 10 tech companies dominating SPY are aggressively withholding dividends to fund massive AI infrastructure.
Right. The dry sponge.
But eventually, those companies will mature. They will transition from high-growth spending phases into massive cash cows. If those top 10 tech companies suddenly start paying out massive dividends out of their AI cash flows in the future, will SQY's UIT cash drag flaw, its inability to instantly reinvest those dividends, suddenly become a much larger crisis for its long-term holders?
Man, that is a huge culture. If the tech giants finally decide to start writing massive checks, SPY might not be structurally equipped to handle the influx of cash efficiently.
Exactly. It's something to think about.
All right, listeners, what's your take on the future of SPY? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.